Hello everyone, this is Sam from SaberiSixRealEstate as well as REALTRON back with another video. So in today's video, I'm actually going to discuss the pros and cons associated with investing in real estate. Now this video is meant to be an elementary introduction, meaning it's for beginners only, but if you are an advanced investor and know a lot about this kind of stuff, then feel free to continue watching. But I just want to preface that this is meant for beginners, people who have not really started investing in real estate and have only talked about it or thought about it, or they know people who have done it. So for that reason, it's just introductory information. The pros and the cons will be at a basic level. Another preface before we get to it: these are not the only pros, these are not the only cons. There will obviously be a couple of pros or cons that I did not mention, but in my opinion, these are the most important ones. Lastly, the pros and the cons on this list are the case I would say about 95% of the time. There will be exceptions to the rule, but we cannot confuse the exception to the rule with the rule itself, right? So if I state a certain con and you know someone that did not experience that con, or someone who did not experience the pro, does not mean that it's not the case on aggregate for the majority of people on average. Lastly, feel free to subscribe, comment, rate, and review if you enjoy this video. If not, leave a dislike. I'm always open to honest feedback, even if it's negative. As well as stay tuned for 2 more episodes of What Your Money Can Buy coming out very soon. All right, so first let's start with the pros, and then we will move on to the cons. Pro number 1. Real estate, as a general rule, appreciates over time consistently. So land as a commodity is a very, very finite and scarce commodity. So another way to put this is that land is finite. Now, other commodities are not necessarily finite. Surely they're not infinite, but they can always be produced. So think about stocks, right? Let's say you own 50 shares of a company and all the company's outstanding stocks amount to 1,000 shares. So you own 50 shares of a total 1,000 shares that the company has outstanding. 50 shares in this example is a good chunk, but this does not mean that the company cannot dilute their shares further and create another 1,000 shares. So your 50 shares becomes a smaller percentage of the total amount of stocks outstanding. The same cannot be said with land. If you own land, we cannot just produce more land. Surely we can produce artificial islands on, water, but even if we take that to its logical extension, eventually we'll run out of service area to create artificial land on top of the natural land we already possess. For that reason, real estate is a very, very scarce and finite commodity. Moreover, land will always have an intrinsic value. So let's take the example of a stock once again, right? A stock's value is only the dollar amount associated with it. So stocks are not actually useful. If they lose their financial value, or if the company that you own a stock of goes out of business, right? That stock is useless. You no longer can do anything with that stock. Whereas land, even if we live in a world, a society where we've collectively decided that we're gonna operate our economy on a trade and barter system, we're gonna dissociate ourselves from money, right? If that's still the case, land will still have some sort of intrinsic value. Sure, in that case, you could still trade it in for, I don't know, like 50 barrels of bananas or hundreds of cows. So even if you choose not to trade in your land for money that doesn't exist or for any other goods, you can still build upon your land. So in that sense, land has an intrinsic value that will always exist irrespective of any financial amount associated with its value or what you can get in return of the land. And once again, real estate just generally appreciates over time for these reasons I described and other reasons. Stocks can go up and down. Sure, you have your fired companies that go up a little every year, but they continually go up. If you look at the graph, they're on an incline, they're just going up. But with real estate, you don't have that daily up and down. It's a consistent growth. Even in the worst of times, it might dip a bit, but it will always go back up for the reasons I described. Pro number 2, real estate allows you to use leverage. In other words, real estate allows you to use borrowed capital. Leverage refers to the use of borrowed capital to purchase your investment product, meaning the land and the structures upon, and furthermore, increase your return on that investment. So let's go through an example, shall we? So let's say you have $100,000 to invest. You have two options. Option number 1, you can buy one house, which costs you $100,000. You can pay the whole asking price with cash, so you don't have to rely on a mortgage or financing. That means you don't have to pay a monthly mortgage payment of any kind. And you purchase this house for investment. Or option number 2, instead of taking your $100,000 and purchasing one property, you can take that $100,000, divide it into $50,000 and $50,000, and purchase two properties for the price of $100,000. Meaning, because of the use of leverage and borrowed capital, you have the opportunity to purchase two properties which cost you $100,000 each, for which each of them you have to put down $50,000. So in the second case, what you've done is you've taken your $100,000 and you've scattered it around amongst two properties and then purchased two properties instead of one property. Now, why is this better? Well, assuming everything else being equal, meaning your desires, what you want out of investments, how long you want to hold on to these investments, properties are the same, locations are pretty much the same. Everything else being equal, basically real life doesn't get in the way of this example. You can most likely sell those two properties and at the end of the day, subtract all your costs, make a higher profit than just selling that one property in the first case. Even accounting for the mortgage payments you have to pay in the second case, which are absent in the first case, because in the first case, you did not use borrowed capital. You purchased everything 100% cash. You're not paying mortgage. So even including that into the equation, you still will most likely make more money in the second case. So for that reason, real estate is a very, very interesting form of investment because the use of borrowed capital really, to this extent, does not exist in other forms of investments, right? I can't really think of an equivalent in trading stocks. Moreover, not even thinking of it in the context of purchasing two properties versus one, let's say you only want to purchase one property, right? Due to leverage, for $20,000, you can own a $50,000 or $60,000 asset, correct? That's not the case. With stocks, whatever the stock, the market rate for that stock is, if it's $50 a share, if it's $55 a share, if it's $10 a share, you have to pay that price. But in terms of real estate, if you save enough and collect a certain amount of capital, you can invest that capital and buy something that's worth 3 times that capital. In other words, in real estate, you can buy a $100,000 asset with $20,000 to $40,000. With real estate investing, the owner of the asset has a lot of control. All the property rights do not just refer to houses, which most people assume and use the word property rights in that context, which is fair. They refer to anything you really own, right? Legally. Even if it's an intangible product, if it's your music, if it's an idea you have, you can own that as your property. So even though that's the case, it still remains a fact that owners of real property, meaning structures and the land upon which those structures have been built, enjoy a higher degree of ownership over the land and the structures than they might enjoy over other products or other commodities they own. There are many more rights that protect you as a owner of a house versus if you are an owner of stocks, or if you collect antique lamps, or if you are owner of your ideas or music. Sure, there are still rights associated with your ownership, but property rights, in referring to real property, are one of the areas where the owner enjoys a great advantage in the eyes of the law, at least in North America. When you really think about it, when you own X amount of shares in a company, All you can do is do your due diligence, research that company, do your projections, see what alternatives exist, study that sector, that industry you're investing in, and hopefully you've made a educated guess and an educated bet on that company, and your homework pays off, and what you imagine and what you project comes to fruition, and you make the profit which you projected in the first place. However, you don't have control over that company. Meaning, even if you own a good portion of the shares that are outstanding, 25%, 30%, you are a major shareholder, and at the end of the day, the CEO and the executives of that company have to appease you in certain senses, but you cannot make the decisions. But if you're the owner of real property, once again, land and the structures that are built upon that land, you make the final decisions. It's your property, you own it. Now, obviously, there are cases where you co-own it with someone else, but even then, it's just the two of you, the three of you. It's you and your wife, or you and your partner, or just you. The success of the investment or the failure of the investment, the profit you can reap or the losses you can accrue, ultimately are in your hands, even given the market and the economy. And if there's a worldwide pandemic like we're experiencing right now, or if everything is hot, all other things being equal, ultimately you have the majority of the control in your hands. Pro number 4, real estate can be a good source of cash flow. Typically, most people refer to this as passive income, aka rental income. So what we're referring to is a situation where you buy a property for investment purposes, and what you decide to do is occupy it with a tenant who's going to pay you rental income, and in turn you use that rental income to pay off some of your costs and hopefully pocket some profits, aka passive income. Now, interestingly enough, we're going to talk about this later in the con sections, because there's couple of cons associated with this pro, but for now, let's discuss this further. So if you decide to rent it out and do your due diligence, you can make a good amount of not only income that covers your costs, but profit. In a way, you're getting your return on investments in two ways simultaneously. One in a more direct way, and the other in a more indirect way. The indirect way is just the value of the property you own as part of your investment portfolio, the thing you can call your asset. Every quarter, you can do research to see how much that property you own is worth, how much you've paid off in terms of your mortgage, and how much you can sell it at that moment within reason. So you can calculate through appreciation how much that asset you have is worth, and if you were to liquidate it, how much you can get. So that's more indirect. However, the direct way you're getting your return on investment is the cash flow. So you have an asset that's not only appreciating in value, but it's also providing you with cash flow. And once again, not many other avenues of investment provide that unique opportunity. All right, now let's move on to the cons. Con number 1, real estate investing has a high barrier of entry in terms of how expensive it is to get started. That's why most people start investing in stocks, because stocks you can start at a reasonable price. Because you can invest in stocks or start investing in stocks with just $100. Let's say you have $100 at your disposal that you can use for investing, and you see a company and you're like, you know what, I can buy 5 shares of that company. Whereas you cannot invest in real estate with $100 at all. Now, if you recall in the pro portion, I stated one of the pros is using borrowed capital. You can invest in a $100,000 asset, meaning own a $100,000 asset by just spending $20,000 to $30,000. Now, that still remains a pro, but even getting to that $20,000, $30,000 down payment for you to even use the borrowed capital, it still requires a good amount of effort and savings. For that reason, you have to save or be lucky in terms of having a lot of disposable income to get even started as a beginner. For that reason, you often see most beginner ventures into real estate investing being amongst 2 people or 3 people. And it's for that reason, because they pool their capital together and they start investing. Just the amount of money you need to get started in real estate investing can pose as a con for many people and a deterrent. Con number 2. Real estate investing requires a long amount of time for you to see substantial return. In other words, it requires patience. Now, in my opinion, this is not really a con in the traditional sense of the term. It's not, I guess, detrimental to your project. However, if you're not a patient individual and you're not able to or willing to, or both not able or willing to sit on an investment for a long period of time, then real estate investing is not the avenue for you. I mean, simply put, you cannot day trade with houses. You cannot day trade with property or land or structures. And this is even in hot markets. In hot markets, you still have to sit on a property for a long time. Now, obviously, less amount of time in normal conditions or slow markets. If there's an economic downturn, or if the market is okay and healthy, but it's just not hot in a sense. And if it's way too hot and you can flip a house every 6 months and make a substantial amount of profit, or every 3 months, let's just get ridiculous with the time frame here, then there's something wrong with the market. It's a bubble that's gonna burst. Ideally, if you have the means to, and if you are able to in terms of the measure of your patience, you would sit on a property for 5 to 10 years. And then you can see a good amount of return on your time, energy, and funds. Con number 3, there exists a lot of potential cash flow disruptions. And this is what I was referring to in the pro section when I talked about how real estate can be a good source of cash flow. I said I will talk later about it in the cons portion. And for this reason, I think rental income cannot be really categorized as passive income like many people do, because it's not really a passive source of income. I guess literally, if you're going by the strict definition, you can argue it is, but in practice, it's not passive whatsoever. There's a lot of work you put into it because you have to do your due diligence. So what are these potential disruptions in cash flow that I refer to? Well, if you do not do your due diligence and just rent it out to anyone, and you do not research or hire a realtor to do this for you or do it yourself, research the tenant, see if their portfolio matches yours, see if they're good tenants, then you will experience many disruptions in your cash flow, whether it be the tenants defaulting on their rent, so they don't pay you rent for that month, which in turn puts you at risk as the owner for you to default on your mortgage payments or other bills, or they do pay rent, but they damage the property. And there's other disruptions of your cash flow that we can account for that necessarily does not have to do with the tenants. So your cash flow in terms of rental income, passive income, if you want to call it, is not guaranteed. And there can be a significant lull in that amount of cash you're supposed to receive that month. Bad tenants can really screw up your cash flow, really. Con number 4, real estate is not a liquid asset. When you think about owning real estate, it's not like other assets where you can convert it into its cash value or whatever bartering value you can come up with if you're trading it. You cannot convert it to that value immediately at all. When you think of stocks, stocks are very immediate. You can buy 50 shares of a stock at $5 a share and then in an hour sell those 50 shares at $10 a share. With real estate, if you see the right opportunity to dispose of it and make a lot of cash, or if you cannot afford this investment any longer and you need some extra cash, you cannot just sell it immediately. You cannot convert it into cash ASAP. It's not liquid in that sense. Selling a property, even in a really good market, can take a long time. Now, obviously, the hotter the market, the better the market, the less amount of time on average your property stays on the market and you can sell it. But we're not even talking about the amount of time it stays on the market and the amount of time it takes for you to sell it. It could take a day to 3 days for you to sell it, but that does not mean you get your proceeds, the proceeds you get from the sale in 1 to 3 days. If you sell a $500,000 property in 3 days, you do not get your $500,000 in those 3 days. There's a closing period. So once again, your property can be on the market for a single day, 3 days, 5 days. That does not mean you get your money as soon as you sell it. Typically, there is 2-month buffer, 3-month buffer, which we refer to the closing period, where it takes you from the moment you've agreed to sell it to the moment the property officially becomes another person's and they give you the cash and you get the cash. There's a 3-month period to that closing date. Obviously, you can negotiate these terms if you want a short closing or a long closing. That's all negotiable. However, typically, you're at least talking about a month, assuming your property is only on the market for 5 days. Whereas stocks, once again, you can sell them immediately. If you collect antique shares. You can sell those antique shares at a auction. This is both assuming that you need the cash or you just want to cash out on your investments, or both. In that case, it's not really liquid. You cannot immediately convert your asset into cash ASAP. All right, so those are the pros and those are the cons. Once again, this was meant to be a beginner video. I will make a more in-depth detailed video for intermediary investors and expert investors. In the future, I have 2 more videos coming up of what your money can buy, as well as I'm starting my own podcast with a colleague of mine. I've created a separate channel. Once we come out with our first episode, I will make a video on this channel and link you to it. Feel free to go to that channel and subscribe and listen to the podcast. And yeah, thanks for watching. Feel free to subscribe to this channel. Like if you like the video, dislike if you dislike the video, and give me some feedback in the comments. Thank you very much for watching and stay safe.